Well, let's get a little more on the economy that any new government will be wrestling with from next week. I caught up with one of the nation's leading economic experts, Bill Evans, Chief Economist at Westpac.
Bill Evans, it's good to talk to you.
My pleasure to be here, Tiki.
Now, kicking off with Joe Hockey and Andrew Robb's announcement today, apparently charity begins at home when it comes to the economy, at least.
Well, we've seen that there's going to be further allocation to infrastructure, and that's something that I support very, very strongly indeed. I think that Australia's productivity will be raised as a result of higher infrastructure investment. Our ability to grow the population more rapidly is also a key factor behind infrastructure. So I do support the idea of further infrastructure investment.
And this, of course, is on the back of, you were talking earlier about the RBA's disappointment, really, in the June quarter figures on capital expenditure in various sectors.
Yes, well, the June numbers were disappointing in the sense that it confirmed to most of us that our suspicion that mining investment has probably peaked. And secondly, that the boost that we're looking for in the other parts of the economy, the non-mining sector, has been very disappointing. For instance, the survey suggests that whereas 6 months ago we thought that the non-mining sector was increasing their investment in 13-14 by about 11%, the latest report indicated that's now flat.
One would imagine that there's going to be a fair bit of flack on the cutting, $4.5 billion cutting in foreign aid. Now, Andrew Robb today defended this by saying that actually we're currently borrowing from overseas to fund our foreign aid programme anyway, and we need to kick-start domestic growth before we grow foreign aid.
Well, I certainly agree with the idea of infrastructure, and I have to say that I'm not much of an expert on foreign policy, so I will leave that to the politicians as to how they assess that one.
On the infrastructure side, $10 billion, of course, it's not all $10 billion. $6 billion is a redirect from the existing government national nation-building programme. Now, that also would provide an 80-20 split, Commonwealth providing 80% of the infrastructure, the states 20%. Do you think that would be a sensible idea in terms of incentivising the project?
Look, I've always been a strong supporter of more of the funding of infrastructure going towards the Commonwealth, even if we just look at the relative cost of borrowing money. A AAA state still borrows at about 50 to 60 basis points more than a Commonwealth, and a AA plus state over 100 basis points more. So it's a lot more expensive for the nation to be funding infrastructure through the states rather than the Commonwealth. And so any movement in that direction, I think, is a good move.
And Bill, what do you think about the timing back to surplus from the opposition's point of view and this $6 billion figure that they've arrived at?
Well, if we look at the latest projections from the PFO or from the economic statement, we notice that in the next 3 years that the deficit will accumulate by about $60 billion, and then we're looking for a surplus of about $4 billion in 16-17. So the overall deficits that we're looking at over that period around $55 billion. So anything to reduce that, I guess, is to be welcomed.
You've said that it's the intransigence of business confidence which is at the heart of Australia's economic challenge. The other side of this weekend, if we get a decisive victory one way or the other, do you see much changing there?
Oh, look, I think one of the things that's really held back business has been their concerns about a hung parliament when the government did not have a majority, and I think the business tends to see that as being a government being hamstrung in terms of them being able to carry out their program.
So even though that's a perception, because we have had various people coming out over the past week saying, well, that's one small thing, but really there are many more fundamental things wrong with the economy than just a perception issue.
Oh, of course, there are many other things I think that are holding back business confidence, in particular the ongoing very high Aussie dollar. We, for instance, look at the level of the currency that would be necessary to reboot, say, the non-mining part of the economy, the services sector, and the Aussie dollar needs to be about 70 cents. So people in those industries still are struggling with a very high currency, even with the welcome fall that we've seen down to around the 91 cent level.
Where do you see the Aussie dollar heading, and at what level do you think we'll start getting business confidence coming in? I mean, you mentioned 70 cents, but presumably some level before that we'll see some confidence come back.
Well, I think businesses will be very much focusing on the perceived improvement in their underlying sales. And that, of course, comes down to how the consumer is feeling about the low interest rates, about what we're now seeing in terms of stronger property prices. There should be a positive wealth effect coming out of that. But we still do have what we call a very cautious consumer who's still focused on deleveraging their debt levels. And that means that the recovery is likely to be very slow. For instance, we don't expect to see growth in 2014 much above 2.5%, coming off the 2.5% we've had this year. So given that the Reserve Bank has been cutting interest rates now since November 2011, rates down to 225 basis points, I think the response this time has been much more disappointing than we've seen in the past.
Interesting that you talk about consumer confidence and business confidence, and that they've reacted in quite a different way to the recent falls in interest rates.
Yes, that is interesting, that consumer confidence has responded much better to the falls in interest rates than business confidence. I think what's boosting the consumers is the fact that they're feeling much more comfortable around their own finances, and lower interest rates, of course, do support that, whereas businesses are looking at their projected sales, looking at the high currency, and feeling that their prospects are not improving rapidly enough.
But you also see concerns from the consumer side over job security.
That's right. So I think that the reason why they're still concerned about their jobs, I think, is directly linked to the weak business confidence, because at the end of the day, it's businesses that make those employment decisions. If they're lacking in confidence, then the employment decisions won't be coming through, and that'll feed straight back to how consumers perceive their own job prospects.
Regardless of the outcome this weekend, you still see room for the RBA to move twice, once this side of this year and the other, and down to further early next year?
Oh, look, I feel that the inflation environment is still very comfortable. The Reserve Bank is predicting that this year inflation will be 2.25%. That's in the bottom part of their 2 to 3% band. So that means that there's adequate scope to cut interest rates. Do I believe that lower interest rates help? Yes, certainly. I think it certainly provides better cash flow for businesses. It puts downward pressure on the currency. And there will be some households who will believe that this improvement in incomes can be spent. So lower interest rates will help the economy, and I believe that we certainly do need those lower interest rates.
Retail growth, of course, has been very sluggish. Are we looking at a new norm in retail?
Well, we've been through this period now for some time with the cautious consumer. I think there was a huge change when the global financial crisis hit the economy. People realised they had too much debt. They got worried about their jobs. And this decision to deleverage over a long period of time is still with us. And I think that's what's really weighing on retail. And of course, it's showing up in the fact that if they're concerned about their jobs, they're concerned about they're cutting back on their spending. And to get all these things moving together is a very difficult thing. And in the past, the circuit breaker has been lower interest rates, whereas on this occasion, the response to interest rates has been a lot more muted. But, as I said, there have been some encouraging signs, particularly around house prices.
Well, just on house prices, do you see that making a major contribution to pulling the economy out of the doldrums?
Look, I think that they will certainly help in terms of a wealth effect. People will feel richer. They may indeed even draw down some of that additional equity to spend, although the days of that being a key driver of the economy that we saw before the global financial crisis, I think, have passed. So it will be a positive effect, but my view is that the deleveraging force will still be the dominant one. And as a result, I don't see the likelihood of a runaway house price inflation that would threaten stability of the economy and would threaten low interest rates and would put a constraint on the Reserve Bank's ability to cut rates.
But perhaps enough to tick the economy along a bit.
To provide some sort of a positive wealth effect and certainly a boost to housing construction. And even though we saw housing construction go backwards in the national accounts yesterday for the June quarter, we are starting to see quite a boost to building approvals numbers now, and I think that augurs well for a boost in housing construction. But the other parts of the other big drivers of domestic demand, being consumer spending and non-mining investments, still look very sluggish.
The government has been relentless in its attack on the opposition about possible cuts, if not now in these costings, then after an Abbott government is created, were this to happen over the weekend. Now, you'd think that, though, such cuts wouldn't probably happen until after the audit that they're speaking about occurs. What sort of job do you think an Abbott government would have in terms of balancing cuts on the one hand and not going too far?
Well, my view is that the economy is fragile at the moment, and an aggressive fiscal tightening would not be the appropriate policy. And I'm sure that whoever gets elected tomorrow will adopt that approach. When we look at our overall debt levels, Australia's gross debt to GDP, including state debt, is only 24%. And that compares with nearly 40% in New Zealand, more than 60% in Canada, and of course the 90s to 100s that we see in Europe and the US. So we're in very good shape, and so aggressive fiscal tightening in order to deal with that problem when we have a fragile economy, I don't believe either party would approach it in that way.
Have you got a tip for me on who might be running a commission of audit under a possible Abbott government?
No, I'm not that well connected into the public service, so that would be a rather a random sort of a tip.
One for Peter Costello?
Would be a very strong candidate.
Okay. Bill, we're off the other side of the investment boom, but we should be in full production phase right now with tax receipts coming in for the government. You'd think that in terms of growth in the economy, this should be a prime time, shouldn't it, in terms of the cycle?
But we are facing these big structural changes, and the first one, of course, being the fact that the leveraging household sector is still deleveraging, and the other big force that drove the economy when the household sector slowed, the mining investment boom has peaked. Where you saw in the national accounts yesterday where engineering spending, which is mainly mining, in the year to June 2012 grew by 55%. In the year to June 2013 grew by 1%. So it's very clear that that key driver is now flattened out, and of course in due course that will start to become a drag on growth as these projects are completed and they're not replaced by other projects. So there are a couple of really big headwinds for the Australian economy, and that's why I'm such a strong supporter of the concept of boosting our infrastructure investment, because I think that's going to be the next big story for the Australian economy, because we need it, it's affordable, it'll boost productivity, and it'll help us grow our population more rapidly.
What is your outlook for the Australian dollar at the moment?
Our forecast is that it'll still be around 92 cents by the end of the year. The currency markets are strange beasts. Up until April, it was trading at about 10 cents above where we would call its fair value. So we had fair value around 92 cents and it was trading in that 102, 104 range. The main reason why the Aussie dollar was trading well above its fair value was the existence of quantitative easing around the world, particularly from the Federal Reserve. So that is generating a lot of loose liquidity that's finding its way into high-yielding currencies like Australia. Once the market sensed that the quantitative easing was going to be cut back a little, and you're obviously well on top of the tapering debate, currency markets tend to take things to the end game immediately. So they basically priced the Aussie dollar as if all quantitative easing had ended, and so we got straight back down to the 92 cents back at fair value. To argue that it could go substantially below fair value would require a much bigger fall in commodity prices and therefore fall in fair value than I'm expecting. We're encouraged by some more positive data in China. We're encouraged by the fact that the key commodity prices seem to have stabilised now. So we're not really looking for another big leg down in commodity prices over the course of this year, and we're not really looking for a case to say that the Aussie dollar should suddenly trade markedly below its fair value, having been above for so long. So I think some stability around 92 cents will be the place to be, and when the Reserve Bank cuts rates, that could put some downward pressure on the currency. But the big move, which would be a big correction to the level of the currency relative to fair value, or a big fall in commodity prices, we're not looking for either of those.
Bill Evans, it's great to talk to you. Thank you.
Thank you.